Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our December monthly market update, the last one for this year. Before we begin, we want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we want to wish our clients a very Merry Christmas and Happy New Year with your families. We also wanted to let you know that our team participated in Reefs Across America this past Saturday, where we donated reefs on behalf of our clients and family members that served or are serving. And we want to ask you if you have military members in your family that we can honor in our Wall of Heroes on our website, please send us their photo. We also enjoyed seeing many of you at our Tamales and Treats curbside event on Saturday, December 7th. Thank you to all of those that participated. We donated hundreds of items to Finishing Touch Ministries and had a great time, even though it was a little bit cold and rainy outside. It was great to see so many there. Our next event will be on January 29th. Hard to believe 2025 is almost here, but we look forward to seeing many of you at our upcoming quarterly investment forum that you'll be receiving an invitation for soon. As it relates to markets in the most recent full month of November, after being down in October, stocks and bonds, they both rallied in November. A lot due to the fact that the election that was a risk going in has kind of got past us in an uncontested way. So markets responded positively for the month of November. The Fed has also started cutting rates, including a cut on Wednesday, the 18th. 50 basis points was the first cut in 4 years in September, and then another 25 2 days after the election on November 7th, and then one on Wednesday, December the 18th. It's unclear to know how many times the Fed will cut rates next year. The speculation going into this year was as many as 6 rate cuts. We wound up getting 3. So that's something that we're continuing to follow, not just what the Fed does, but what the Fed says going forward. The most recent jobs report was a significant improvement over October, and the revisions were to the upside. So 227,000 jobs added, unemployment rates at 4.2, average hourly pay over the last 12 months up 4. And the most recent inflation report, a little hotter than expected, but still under 3, up 2.7. GDP was down a little bit, but still positive. So the third quarter of this year, the second estimate was at 2.8. So again, that's a bit of a decline from Q2, which was at 3 annualized, but still shows the economy growing. And the economy growing is significant because it talks about what the markets typically do after the Fed starts cutting rates if there's no recession. So if we are in a no recession environment after the Fed starts cutting rates, which again, they started in September, this is the 12-month return on stocks and bonds. So you see really positive for both. If you get a recession, however, within the next 12 months, stocks go opposite of bonds. So bonds are still supportive, but stocks are negative. So again, what we know is the Fed started cutting rates. What we don't know is if we get or not the long anticipated recession. So that's something we're carefully following. We're also in a period of time that is typically cyclically good, that goes from October 31 to the end of April. And kind of what this shows is that since 1926, on average, you get 4.4 from May to the end of October, but positive 7.5 from November 1 to April 30, which is the period of time that we're in. In the last 40 years, if we want to look at more recent time frame, basically follows that same thing. So we're in a cyclically good period of time for the market. That doesn't mean that other factors can influence this and make it different, but typically the calendar period from 11/1 to the end of April is a good period of time. So we continue to see this dynamic play out of the market being very concentrated. You'll see the weighting of the S&P 500 in the top 10 stocks, and we're going to even narrow this in the next slide to the top 7, is 39% of market cap. They're also responsible for 41% of R&D expense and 26% of free cash flow. So the one open question is, when is this 39% justified? It may or may not be going forward, but this indicates some argument for this concentration. And as it relates to price, stocks are expensive at this point. If you look at the S&P overall, they're trading at 22 times forward earnings versus an average of 17. But that's really even further stratified in terms of the remaining stocks outside of the top 10 and the top 10. So the top 10 stocks are very expensive, 151% of average, versus the remaining stocks aren't nearly as expensive. But overall, you're looking at a market that is pretty expensive overall. And again, we talked about the top 10 being 39%. It's actually the Max 7 is a third now of the S&P 500 in these 7 names. And over the last 30 years, the median weighting of the top 7 is only about 16.5. So you're looking at a doubling of that today in terms of how large the large companies in the S&P 500 with really a commonality of technology are. Even if you look at the peak before the dot-com bubble burst in 2000, the top 7 stocks, and you'll see those names listed here, were only 20%. So we're in a very concentrated market. That's something to very closely follow. You'll also notice that the only one of these names that were the same now as we were in 2000 is Microsoft. All the other names have changed. As it relates to widening out, we did see a widening out of beating of the index in Q3. So that more than 60% of the S&P beat the index in Q3 compared to only 25 in the first half of 2024. So that's some indication of some widening out of performance. But again, the S&P 500 is still driven. Half of the performance this year is because of the 7 stocks we just listed. On the kind of concerning front, debt levels remain a big concern. This is where we are on a deficit basis, and this is what's projected to happen. Whether or not we will be able to make meaningful headway this way is something that we're waiting to see, but this remains a big issue with 36 trillion in debt and more in debt service now that we're spending on defense. So this is a key area to watch. As it relates to kind of post-election, there's some indication with CEOs and business owners that roughly 2/3 had pent-up business activity pre-election. So now that we're after that, this could be a positive sign for the markets. And now that we have election results, not just president, but House and Senate, we can look at what that means in terms of amount of time. Only 10% of the time do we have the environment that we're in now. And on average, when we have it, on average GDP growth is 2.8, which is about where we are today. And again, the same 10% of time where one party, where the Republicans are White House, House and Senate, the average stock market return is 12.9. And then where are we in the election year period of time? You'll see all years, presidential election years, midterms, and then the kind of off year, non-election odd years are pretty good for stocks overall in the first year of a new administration. So we'll continue this list with some slight updates, kind of some reasons for pessimism that we do get the long anticipated recession. It hasn't happened yet. It's been long predicted, but hasn't happened. If we do get it, that would be negative overall. The employment, we had a very weak jobs number in October, but a much stronger one in November. The consumer weakens. The Fed cuts rates less than the market's anticipating in 2025 now at this point. There was some kind of no hurry language at recent Fed meetings. So that's something to follow. Geopolitical risk is certainly elevated today. Debt levels remain a concern. Earnings at any point could disappoint going forward. And then we did have the election as being a cause for elevated risk around an election, and we're moving this to optimism because now the election's over and it also is not contested. So the reasons for optimism is that the recession delay continues to be delayed and we get no recession in the near term. Inflation is lower. The Fed cuts rates as expected in the market. Again, not just in 2024, but going into 2025. There's some widening of performance outside of the top 7 or top 10. Earnings continues to be supportive. And again, we move this in the positive side. The fact that election uncertainty is no more, that we had a non-contested election on November 5th, and now markets can factor what that means for 2025 and beyond. We will be adjusting our targeted allocations and doing a rebalance in the coming days. Look for trade notes talking about the themes that we'll be addressing in the rebalance. Again, none of this is a kind of a replacement to talk to us directly about how all these things apply to you. So please feel free to reach out to us if you have any questions at all. Again, we hope to see many of you at our New Year Quarterly Investment Forum on January 29th. Look for an invitation for that very soon. And we'll close with wishing, again, you and your families a very Merry Christmas and Happy New Year. Again, we thank you for the privilege it is to serve you as a valued client of our firm. If we can do anything at all to serve you, please let us know. Until we see you again, be well and take care.